Hello financial fans, welcome back to another stock analysis. Today we'll be covering Lowe's Companies, stock ticker LOW. Lowe's Companies Inc. is a retail company that operates a chain of home improvement and appliance stores. They sell a wide variety of products for home improvement and construction products including lumber, paint, tools, appliances and home decor. They also provide services such as installation, repair and maintenance, and rental of tools and equipment. They target both professional and DIY customers. The company operates stores in the United States, Canada, and Mexico, and also sell products online. They are known for providing a wide range of products, knowledgeable and helpful employees, and a good customer service experience. Currently, they operate around 2,200 locations, and they currently have a market cap of $126 billion. In 2021, they generated a revenue of $96.3 billion, and the dividend yield is currently sitting at 2.01%. They are currently a dividend aristocrat, which means they increased their dividends for more than 25 consecutive years. And they're also almost a dividend king, because they have raised their dividends consecutively for 48 years out of the 50 years required to become a dividend king. 95% of their revenue comes from products, 3% from services, and 2% from other various streams. 94% of the revenue comes from the USA, and 6% is international. To determine our final valuation for the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. And we'll be using a standard margin of safety of 25%, which can either increase or decrease by the ratios that we're going to look at in just a moment. The severity that this ratio will increase by is determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors in our scale, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two ratios that we're going to look at are the EBIT growth and the margin growth. The EBIT is barely visible, but it has gone from $3.6 billion in 2013 to $12.2 billion in 2022. So a solid increase, in my opinion, and the average growth during this period was 16.8%, meaning a 5% deduction from our margin of safety. The margin has also gone up quite significantly, going from 7.2% to 12.7%. That's a huge increase, and the average growth during this period was 8.9%, meaning a 5% deduction from a margin of safety. The next two ratios that we're going to look at are the dividend growth and payout ratio. The dividend has gone up in a quite significant manner, going from 92 cents a share annually in 2013 to $4.20 a share annually in 2021. The average growth during this period in dividends was a whopping 21.2%, meaning a 10% deduction from a margin of safety. The payout ratio is sitting at a very solid 36.3%, meaning no change in the margin of safety. The final two ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, you have to take the debt, subtract the cash from it, and then divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Lowe's, this is exactly 2 years, so a 200% debt to EBITDA ratio, meaning no change in our margin of safety. The return on invested capital for Lowe's is sitting at a very nice 22.9% return on invested capital, meaning another 5% deduction from our margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Lowe's. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2013 to 2022. The average growth in free cash flow during this period was 26.5%. But since we're calculating the expected growth up until 2030 for Lowe's in free cash flows, I've gone with 35% of this average growth, which is 9.26%. With this percentage, we can determine the future free cash flow for Lowe's and determine a terminal year of valuation, using a perpetual growth rate of 2.5% and a discount rate of 9%. Then the sum of free cash flow, the present value of the sum of free cash flow, is $200 billion. And all that's left to do to get an equity value is add the cash and equivalents and subtract the debt. Doing this, we get an equity value of $171.8 billion. And to get a discounted cash flow price, we just have to divide it by the amount of shares outstanding. Out this model then, we get a discounted cash flow price per share of $284.16. With the current price of $208.50, we get an upside of $75.66, which is an upside of 36%. The second model that we'll be using is the dividend discount model. I've imported the dividend payments going from 4 years ago to the current year. The average growth in dividends during this period was a very high 22%. But since we're calculating the lifetime expected growth in dividends for Lowe's, I've gone with a still very high conservative estimate of 7.5%, seeing as they're close to becoming a dividend king. We'll also be using a discount rate of 9% in this valuation model. And out of this valuation model, we get a discount dividend model price per share of $301.39. And with the current price of $208.50, here the upside is $92.89, which is a 44.5% upside. The last model that we'll be using is the multiple valuation. In this model, we'll be looking at similar companies to Lowe's, looking at their stock price and their earnings per share. In this way, we can determine the average PE multiple in the industry, which in this case is 20.21. To get our fair value here, we just have to multiply it by the earnings per share that Lowe's is generating. In this case, that's $10.36 a share earnings per share. Then our fair value on this model is $209.37. And with, again, the current price of $208.50, here we get a small upside of 87 cents, which is a 0.42% upside. Let's go look at our final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, the discounted dividend, and the multiple valuation price per share. Out of this, we get an average of $264.97. The margin of safety we have determined earlier by taking a standard margin of safety of 25%, reducing it by 5% for the EBIT growth, deducting 5% for the margin growth, deducting another 5% for the return on invested capital, and deducting another 10% for the dividend growth, leaving us with no margin of safety at all, which is looking very solid for Lowe's. Then our fair value stays exactly the same as the average out of valuation models, and our fair value stays $264.97. And with the current price of $208.50, we got an upside out of the models of 27.09%, which means in this case, it would be a buy. If there's any other companies that you would like to see on this channel, please let me know. And thanks for watching.